$1. That's all it takes to start this experiment. Not $100, not 1,000, just one single dollar every day. It's the kind of amount most people never think about. It disappears in small purchases, spare change, or a quick snack without much thought. When people hear $1 a day, they usually assume it's too small to matter, too small to change anything, too small to build real wealth. And honestly, that assumption seems reasonable at first, because when you think about investing, you probably picture large sums of money, complicated strategies, or people with decades of financial experience. A dollar doesn't sound like an investment strategy. It sounds like pocket change. But the truth is that investing has very little to do with how big the starting amount is. What actually determines the outcome is something much more powerful: time and compounding. A single dollar invested consistently over decades behaves very differently than a dollar that simply sits in a bank account or gets spent. When that dollar is placed inside the right investment and given enough time, it starts to multiply in ways that can be surprisingly dramatic. That's exactly what we're going to explore in this video. Today, we're running a simple but revealing experiment. Imagine investing exactly $1 per day into several different Fidelity index funds. Same contribution, same timeline, same discipline. The only thing that changes is where that dollar goes. Each fund in this experiment represents a different style of investing. Some are designed to maximize long-term growth. Others focus more on generating dividend income. Some spread money across thousands of companies, while others concentrate heavily in technology or specific sectors. Over the course of 30 years, those differences start to create completely different outcomes. By the time we reach the end of this video, you'll see something that doesn't seem to make sense at first glance. One fund will transform that $1 daily investment into a portfolio worth well over $200,000. Another will build a smaller account balance but produce over $1,000 per month in dividend income. Same dollar, same 30 years, completely different results. And that difference highlights one of the most important lessons in investing. The goal you choose determines the strategy you should follow. Some investors are trying to build the largest portfolio possible. Others care more about creating a steady stream of passive income. And the investments that perform best for one of those goals may not be the best choice for the other. Before we dive into the funds themselves, it's important to understand the tool we're using here: index funds. An index fund works like a basket. Instead of trying to pick one company that might succeed, the fund owns hundreds or even thousands of companies all at once. When you invest in that fund, you automatically own small pieces of all of those businesses. If one company struggles, the others can balance it out. When the broader market grows, the fund grows along with it.
This approach removes much of the guesswork from investing and allows investors to participate in the long-term growth of entire markets rather than relying on individual picks.
This is why index funds have become one of the most widely recommended investment strategies for long-term wealth building. But even within index funds, there are major differences. Some track the entire U.S. market. Some follow only the largest companies. Others focus on sustainability, international markets, or technology-heavy exchanges like the NASDAQ. Those differences may seem small at the beginning, but when compounding has 30 years to work, they can lead to results that are dramatically different. So in this video, we're going to look at 5 Fidelity index funds and see exactly what happens when you invest $1 per day into each of them for 3 decades. Some of these results will be surprising, and one of them will produce the largest portfolio balance in this entire experiment. But first, let's start with a fund that changed the investment industry the moment it launched. The first fund in this experiment didn't just enter the market quietly. When it launched, it forced the entire investment industry to rethink how index funds should work. In 2018, Fidelity introduced something that many people believe wasn't even possible: a mutual fund with a 0% expense ratio, no management fee, no costs taken from your investment each year. Every dollar you put in stays fully invested. That fund is called FSROCs, the Fidelity Zero Total Market Index Fund. To understand why that matters, we need to look at how most index funds operate. Even the cheapest funds typically charge small annual fees, usually somewhere between 0.03% and 0.1%. These fees may look tiny, but over decades, they quietly reduce your returns as they compound year after year. FZOX removed that completely. It tracks the entire U.S. stock market, meaning your money is spread across thousands of companies at once. When you invest in this fund, you're not trying to predict which single company will succeed. Instead, you're buying a slice of the entire American economy. Inside the fund, you'll find familiar giants like Apple, Microsoft, and Nvidia, companies that dominate global markets. But those are only the top layer. Beneath them are thousands of mid-sized and smaller businesses from nearly every industry imaginable. Technology companies, healthcare firms, manufacturers, financial institutions, retailers, they're all part of the same portfolio. This wide diversification is one of the reasons total market funds have historically performed so well. When one sector slows down, another often picks up momentum. Over long periods of time, the broader market has a strong tendency to grow. Now, let's look at the numbers that actually matter for this experiment. FZROX currently produces a dividend yield of about 1%, and that dividend has historically grown around 7% per year. That's not particularly high income, but income isn't really the reason invest. The real engine behind FZROX is its price growth. Over the past decade, the U.S. stock market has delivered average annual returns around 12%, driven by innovation, productivity, and the long-term expansion of the economy. And that growth is what powers the compounding process. So what happens when we put our $1 per day into this fund? In the first year, the result looks almost boring. After 12 months, the account sits at about $365, which is simply the amount that was invested. Compounding hasn't had enough time to work yet. But once time begins to stretch out, the numbers start to move. By year 10, that steady stream of daily dollars grows to roughly $6,700. Nothing life-changing yet, but the momentum is beginning to build. By year 20, the account has expanded to nearly $29,000. At this point, something important is happening behind the scenes. The investment returns are starting to contribute more to the portfolio than the daily contributions themselves. And by year 30, the result becomes far more interesting. That single dollar invested every day grows into an account worth roughly $100,000. 6 figures built from a contribution that many people wouldn't even notice leaving their wallet. Most of that growth comes from the rising value of the companies inside the fund. Over 30 years, compounding price appreciation becomes the dominant force driving the portfolio higher. Dividends play a smaller role here. Even after 3 decades, the income generated by the account remains modest, only around $17 per month. And that reveals the trade-off behind this type of investment. And FZROX is designed to build wealth, not necessarily to pay income along the way. The balance grows impressively, but the cash flow stays relatively small. For someone focused purely on long-term growth, that trade-off might be perfectly acceptable. But the next fund on this list takes a slightly different approach. It charges a tiny fee, barely noticeable in practice, yet it tracks one of the most powerful indexes in the world. And over long periods of time, that difference pushes the final result even higher. The next fund on the list follows an index that most investors already recognize, even if they've never owned a single share of it. When people talk about the market, they're usually referring to one benchmark, the S&P 500. And the fund that tracks it here is FXAIX, the Fidelity 500 Index Fund. Unlike the previous fund, which spreads money across the entire U.S. stock market, FXAIX focuses only on the largest 500 companies in America. These are businesses that dominate their industries and have proven themselves over decades. Inside the fund, you'll find names that shape the global economy: Apple, Microsoft, Nvidia, Amazon, Berkshire Hathaway, Meta, Alphabet, and many others. These companies represent some of the most profitable and influential organizations on the planet. Because the S&P 500 is weighted by market size, the biggest companies carry the most influence inside the fund. That concentration has historically worked in investors' favor, especially during periods when large technology companies drive market growth. FXAIX does charge a small expense ratio of 0.02% compared to the zero cost of FZROX. That might seem like a disadvantage at first glance, but in practice, the difference is almost invisible. What matters more is performance. Over long periods, the S&P 500 has delivered slightly stronger returns than the broader market in many cases. Over the last decade, the index has averaged roughly 13.5% annual growth, a little higher than the total market average. And over 30 years, even a small difference in growth rates can have a surprisingly large impact. So what happens when our $1 per day goes into FXAIX instead? Just like before, the early numbers look familiar. After the first year, the account still sits around $365. At this stage, the investment hasn't had enough time to compound. But once the timeline stretches further, the gap between funds begins to appear. By year 10, the portfolio grows to about $7,100, already slightly ahead of the total market fund. The difference isn't dramatic yet, but it's noticeable. By year 20, the account expands to roughly $33,000, continuing to pull further ahead. And when we reach year 30, the final number becomes much more interesting. The portfolio reaches approximately $125,000. That's nearly $25,000 more than the free fund we just looked at, even though the starting contribution was exactly the same. Once again, most of this growth comes from capital appreciation. The rising value of the companies inside the fund does the heavy lifting over time. Dividends contribute a smaller portion of the total return. By the end of the 30-year period, the portfolio is expected to generate about $90 per year in dividend income, which works out to roughly $7 per month. That number might seem surprisingly small considering the account is now worth well over $100,000. But this is the reality of growth-focused index funds. Their purpose isn't to generate immediate income. Their purpose is to grow the value of the portfolio as efficiently as possible. So after 30 years of investing a single dollar each day, the first two funds together have built nearly $225,000 in total portfolio value. Yet despite that impressive balance, the combined monthly dividend income from both accounts would still be less than $25 per month. That may feel like a strange disconnect, but it highlights one of the most important decisions investors must make early on. Do you want your investments to grow the biggest balance possible, or do you want them to produce income along the way? The next fund in this experiment begins to shift that balance slightly. It still focuses on growth, but it introduces something new, a strategy built around companies that are leading their industries in responsible business practices. And over time, that difference produces one of the most surprising income results in this entire lineup. The next fund in this experiment takes a slightly different approach from the ones we've seen so far. Instead of simply tracking the largest companies or the entire market, this fund focuses on businesses that score highly in areas many investors have started paying more attention to over the past decade. This is where the Fidelity U.S. Sustainability Index Fund, known by its ticker FITLX, enters the picture. When people hear the phrase sustainability fund, they often assume it means something very specific. Some imagine a portfolio filled mostly with renewable energy companies or environmentally focused startups. Others assume that funds like this sacrifice performance in order to meet certain ethical standards. But the reality is much more nuanced. FITLX tracks the MSCI USA ESG Leaders Index. ESG stands for environmental, social, and governance factors. Instead of excluding entire industries outright, this index evaluates companies within each sector and identifies those that perform best relative to their peers when it comes to responsible business practices. In other words, the strategy is not about avoiding industries completely. It's about selecting companies that demonstrate stronger leadership, transparency, and sustainability compared to others operating in the same space. Because of that approach, the holdings inside FITLX might look more familiar than you'd expect. You'll still find major technology leaders like Microsoft, NVIDIA, and Alphabet among the top positions. Healthcare companies, financial firms, and consumer businesses are also well represented. Altogether, the fund holds roughly 268 companies, with the largest 10 positions accounting for a significant share of the portfolio. Another interesting detail is that FITLX is one of the newer funds in this video. It launched in 2017, meaning its long-term track record is shorter compared to older index funds. Its expense ratio sits at 0.11%, slightly higher than the previous funds we've discussed, but still relatively low in the broader world of mutual funds. What makes Fidelity particularly interesting, however, isn't just its holdings or its philosophy. It's the way its dividend growth behaves over time. The fund's dividend yield currently sits around 1.1%, similar to the S&P 500 index fund we looked at earlier. On the surface, that might suggest the income potential is nearly identical. But there's a crucial difference once we look at how those dividends grow. FITLX has historically experienced dividend growth of more than 15% per year, which is significantly higher than most traditional index funds. And when that growth compounds for decades, the results begin to separate from the rest of the group. So let's run the same experiment once again. The first year still begins at $365, just like every other fund in this video. Early on, there is almost no difference between them. By year 10, the portfolio grows to roughly $7,100, nearly identical to the S&P 500 fund at the same point in time. During the early years, the performance of these funds tends to move in similar directions. But over longer stretches, the gap begins to widen. By year 20, the portfolio climbs to approximately $34,700, pulling slightly ahead of the previous funds. And when we reach year 30, the results become much more noticeable. At that point, the account is projected to reach about $146,000. That's already a meaningful improvement compared to the earlier funds we examined. But the real difference shows up when we look at the income side of the equation. Because of the faster dividend growth, the portfolio's reinvested dividends contribute far more to the total return. Over the 30-year period, dividend reinvestment adds a significant amount to the overall value of the account. By the end of the timeline, the portfolio is expected to produce around $2,900 per year in dividend income. That translates to roughly $240 per month. Compare that to the earlier funds we examined. One was producing about $17 per month and another only about $7 per month, even with six-figure portfolio balances. Yet here, from the exact same $1 per day investment, the monthly income has climbed dramatically. The difference comes from two simple ingredients: a slightly higher starting yield and much faster dividend growth over time. But there is still one important limitation to this fund. Every company inside FITLX is based in the United States. And that means the next fund in this experiment takes us somewhere entirely different outside the U.S. market and into thousands of companies spread across the rest of the world. Surprisingly, that global approach produces one of the most powerful income results in this entire experiment. Up to this point, every investment we've looked at has focused on companies based in the United States. American businesses dominate many global markets, and for decades, the stock market has been one of the strongest performers in the world. But the global economy is far bigger than just one country. There are thousands of companies operating across Europe, Japan, the United Kingdom, Canada, Australia, and rapidly growing economies throughout Asia and Latin America. Entire industries exist outside the U.S. that many investors rarely think about. And the next fund in this experiment captures that entire side of the world. This is the Fidelity International Index Fund, often represented by the ticker FSGGX. Instead of focusing on American companies, this fund owns more than 2,000 businesses spread across international markets. From European manufacturers to Asian technology firms and financial companies in emerging economies, the portfolio represents a broad cross-section of global commerce. When you invest in a fund like this, you're essentially buying exposure to the rest of the developed world outside the United States. There's another important difference that shows up in international markets as well. Many companies outside the U.S. have a much longer tradition of returning profits directly to shareholders through dividends. While American companies often prioritize reinvesting profits back into expansion and innovation, international companies frequently distribute a larger share of earnings to investors. That cultural difference shows up clearly in the numbers. This fund carries a dividend yield of roughly 2.4%, more than double the yield of some of the U.S. funds we looked at earlier. On top of that, its dividend growth rate has historically been strong, averaging around 15% annually. Those two factors, a higher starting yield and strong dividend growth, create a powerful combination when compounded over long periods of time. So let's see how the $1 per day experiment plays out here. Just like every other fund, the first year ends with about $365 in the account. The compounding process hasn't had time to accelerate yet. By year 10, the portfolio grows to roughly $6,700, slightly behind some of the U.S. funds at the same stage. That's because international markets have historically delivered somewhat lower price growth compared to the technology-heavy American market. But over longer timelines, something interesting begins to happen. By year 20, the portfolio climbs to around $35,000, catching up to the other funds we've seen so far. And by year 30, the account grows to approximately $205,000. That's more than double the value of the first fund we looked at and significantly higher than most of the earlier portfolios in this experiment. But the most surprising result appears when we examine the dividend income. Because of the higher yield and aggressive dividend growth, reinvested dividends contribute nearly half of the portfolio's total return over the 30-year period. By the end of the timeline, the portfolio is projected to generate around $19,000 per year in dividends. That's roughly $1,600 per month. Think about that for a moment. A contribution of $1 per day invested consistently for 30 years grows into an account capable of producing nearly $1,600 in monthly income without adding another dollar. And yet, this still isn't the largest portfolio balance in the entire experiment. There is one final fund that takes a completely different approach. It focuses heavily on technology companies and the innovation-driven sectors that have shaped the modern economy. This fund sacrifices dividend income almost entirely in exchange for one goal: maximizing long-term growth. And when you give that type of growth 30 years to compound, the final number becomes the largest portfolio balance in this entire experiment.